Welcome to Honeycutt Investment TV. In this episode, we're going to take a look at natural gas E&P company Range Resources. I think the natural gas E&P sector is one of the most attractive for investment right now, and you should check out my earlier article and video on this sector. And I think Range Resources is one of the best companies in this sector to own. Now, one of the reasons I really like Range is that they are one of the low-cost producers, and they've become increasingly efficient over the past several years. And the key to understanding that is their production volume. And you can see that here. They've increased production from 95 billion cubic feet equivalent of gas to 424 billion cubic feet. So almost a 350% increase in production in that 5-year time frame. Now, as production has increased at Range, they've seen their all-in cost of productions fall significantly. And you can see in this chart, it's fallen from about 504 per 1,000 cubic feet equivalent in 2009, all the way down to 266 in 2014. So that's a pretty big drop. And even though natural gas prices are falling, this is one of the reasons why that's not necessarily that huge of a deal. Now, to understand why Range Resources cost of productions are falling, let's take a look at this chart, which is going to break it down. And this chart looks at cost per 1,000 cubic feet equivalent of gas produced. And you can see that direct operating expenses fell from 101 down to 35 cents per 1,000 cubic feet equivalent from 2008 to 2014. And then G&A expenses fallen from $1.01 in 2010 all the way down to 50 cents in 2014. And then per unit depletion costs have fallen from $2.32 in 2009 to $1.30 in 2014. So you've seen improvement across the board as Range's volume of production increases. Now, Range Resources' financials have been improving well, and this has been happening in spite of natural gas prices falling significantly. And the reason for this is that the production gains. So Range, you can see in this chart, a lot of their income growth is being driven by revenue growth from the increased volume. Now, this next chart here, this shows normalized income with a 38% projected income tax. And that improved from $77 million in 2009. It's sort of hovered in the $120 million to $140 million range from 2010 to 2013. And then it skyrocketed to $700 million in 2014. Now, it's likely that it's going to fall again in 2015, but I think you can see 2014 prices improved and income skyrocketed. You can see how sensitive this sector is to price increases, and that's actually one reason why I like this sector right now, because I think prices are going to go up from here. Now, the one negative with Range is free cash flow growth. It's been negative over the past few years, and it's mostly been negative because of capital expenditures. They've had significant capex to increase production, so that's something to keep an eye on, but it's also, given how dramatically they've increased production, it's also a bit expected. Now, I want to look at historical spreads really quick, and this chart might take a little bit of explaining, but I would focus on that realized price number 2, and that includes derivative settlements and third-party transport. And you can see the spread. This is basically a spread between realized prices and production costs. And the spread has hovered from around 80 basis points to 400 basis points historically, but right now it's in the low end of the range. So that's another reason why I think it might come up in the future. In order to value Range Resources, I looked at its proved reserves and then assigned a multiple to those reserves. So these models that I'm going to show you are based on that. And then here you can see currently Range sells at about, and this is at a price of about $37 for the stock price. It's selling at about 95 cents per 1,000 cubic feet equivalent of gas. Now, I think that's very cheap. I think at a more reasonable valuation of $1.50 to $2 per thousand cubic feet equivalent, range of stock price would jump up to the $71 to $101 range. And it has additional upside beyond that. So if you price it at about $2.50 to $3 per thousand cubic feet equivalent, that's a mouthful to say, but if you price it at that, it's about $132 to $162 range. So the thing I want to emphasize here is that right now we're really it looks like we're in the down end of the cycle. This is a very cyclical business. We're in the down end. And even, I would say $1 per thousand cubic feet equivalent is a pretty depressed price, and that still puts us at a $41 valuation. So to me, the stock looks very cheap right now. It's priced really for a I would say semi-depressed environment for the foreseeable future. And given that we're already in year number 7 of a bear market, I think eventually we see improvement. It might take 2 years, it might take 5 years, but natural gas prices are eventually going to improve, and you're going to see the stock price go up significantly when that happens. So as a long-term investor, what I'm doing is I'm buying in and I'm waiting. It's conclusion time, and I think Range Resources is an excellent buy for long-term investors. Be prepared, though, for some volatility. Be prepared for prices to fall further. It's completely plausible. It's selling at 37 right now. It's completely plausible that in 2 months it could sell at 25. But at that point, it's even bigger bargain in my view. So I would, if you're buying in this sector, be prepared to hold for a long time. 2 years, 5 years, maybe 10 years. Eventually, natural gas is going to rebound. The stock prices are going to be much higher in my view. And this is going to turn out to be a very good long-term investment for those who are patient. All right, thanks for watching. I'll see you next time.